I didn't really know what impact investing was. It was the twin of private markets and financial inclusion. There I was at Wellington, and my soul wasn't being nourished to the extent that I needed it to be. And so I was eager for something that would matter. I was given a nice warning with the nicest of intentions. This is a nights and weekends effort for you. Remember, it's not your day job. Because my manager was worried that I would go do this, it would be a flop because whoever heard of such a thing, and then I'd have no job to come back to. In early parts of our areas of impact investing, the question was, do you have to give up return for impact? No one has to ask that anymore. Everybody can see now that you don't have to. You just need to find a good manager because that's what matters. When the show Billions started talking about impact investing, that was one indication that it was mainstream, even as silly as that was.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Long-time listeners of the show will already be acquainted with you and know who you are because you actually appeared on episode 9 of this podcast, which was published in October of 2022. Today, I wanted to talk about impact with you because you've had a really long career in impact investing and are considered a pioneer in impact. For people who don't know you, why don't we just go back a little bit to your roots, because I think you trace your decision to join the U.S. Foreign Service, which was as kind of the seminal choice that led to your impact career. Am I right about that?
Yes, that's right. The careers in my family are all about social service and helping professions and all that. And when I came out of college, I thought, what will I do? And I applied to the Foreign Service. And everyone else seemed to be vying for a job in Paris or a job in London. And I was looking at jobs in Latin America and Africa. And I got my job in Rwanda as a 23-year-old. It was very exciting. And I was in Rwanda. I was in what was called Zaire then, which became Congo, and Burundi, Tanzania, Kenya, elsewhere. That was where I had the bug to do something in development. And so it was pretty clear to me that if I wanted to do economic development, it wasn't impact investing. So that didn't occur to me. I wasn't a business or finance guy. So I thought I'll do a PhD in economics and get a job at the World Bank, which is where one does development. One wants to help the world. And so that's what I did. I got my PhD. I got a job at the World Bank. That was sort of the prototype. Actually, for me, in any case, it was interesting listening to Michelle Giddens talk about the same time. In the same time, she had gotten her MBA. And so she had a different starting point and approach. And she was off to Eastern Europe just like I was, but she was dealing with bank and industrial restructuring. And I was dealing with government restructuring in the same countries, in fact. So it's interesting to hear her talk about that. And so I did that for a number of years. And my leaves of absence ran out after 5 years. I went to Boston. And in Boston, what does an economist do? An economist does funds management. So that's how I ended up at Wellington.
And you kind of actually pioneered at Wellington, maybe the first public equity fund, but certainly one of the big ones to try to go at scale. So why don't you take us through that theory of change, impact in the public markets?
I didn't really know what impact investing was. It barely existed. I mean, I had a great friend, Maya Korengal, who's also been on this show, who had been doing it for a while, but in microfinance in private markets. So when you think about what impact investing was, it was those two things. It was the twin of private markets and financial inclusion. There wasn't the environmental side to any great extent. There was certainly nothing in public markets. The problem is, there I was at Wellington, and my soul wasn't being nourished to the extent that I needed it to be. I started doing work on emerging market consumers and found myself in the slums of Brazil and India, China. And so I was eager for something that would matter. And it had to be something that mattered that I knew how to do. And I knew how to do public markets. So Maya and I met over a number of times to say, well, what would it look like if you took this pivot in impact investing that was pretty incipient in those days toward public markets? What would you have to do to have a theory of change? What would you have to do to engage with companies in a way that was not just ESG? Because people laid out to me, oh, ESG, that's public markets, impact, that's private markets. And in thinking about that, the view that we came to have in my team was if impact investing is only in private markets, and there weren't UN SDGs yet, but we knew the needs were trillions of dollars. You'll never get there. You can do lots of wonderful things in private markets, but you need the scale of public markets to meet the scale of the needs in the world. And so I had to figure out how I could do it and how it could be authentic. And I had undoubtedly the world's best teacher. The other advisor to our fund was Sir Ronald Cohen. I couldn't have wanted for more experience and better insight than the two of them.
You said no one really knew what impact was. What year are we talking about that?
2012, I was the head of an effort that we would do at Wellington called Future Themes. And so we do work on water stress and agriculture needs, healthcare needs, prospects for that. And that sort of framed what companies in the public markets were doing that would be considered impact investing. From the work in 2012, 2013, we built a model portfolio, and then we launched it internally the next year and externally in 2015. It's only 10 years ago that we really hit with this public effort. I was given a nice warning back then in 2013, 2014 that in the nicest with the nicest of intentions. This is a nights and weekends effort for you. Remember, it's not your day job. Because my manager was worried that I would go do this. It would be a flop because whoever heard of such a thing? And then I'd have no job to come back to.
How do you know Maya? Did you work with her?
I knew her from college days. So, no, we never worked together. When I first knew her, she was in college. I was in
No,
graduate
no, no.
school.
I mean, when you
Oh,
guys started doing
when we
this,
worked together, I'm not sure. She must have moved to TPG by then.
say, okay, so you didn't know her from Elevar Equity or anything like that. Right?
I knew her when she was going through all that and building these exciting, quirky things that didn't make a whole lot of sense to me.
So it was Sir Ronald Cohen and Maya who kind of advised you on that strategy.
I didn't know Ronnie before. I sought him out. I saw him speak, and he's maybe, have you seen him speak? He's so inspirational. And he had such a vision of how big impact investing could be. And, he was talking about, okay, we're moving billions of dollars. We've got to move trillions of dollars. And I thought, this guy might be crazy, but he's very inspirational. And of course, my takeaway from that was public markets has to do this and do it right.
You've kind of told us about how you got going on this, but you still haven't made the case for your theory of change.
Oh, true. I haven't. Let me try to do that. The fact is, the companies that we have always invested in are the same companies grown up that would have been nurtured by impact investors if such an industry existed. Or at the time when we did it, they were very similar to small companies that were providing access to healthcare, access to education, whatever area you would be thinking about. And so they looked the same, but they just didn't conceive of themselves as impact companies. And so our theory of change was that we could be dedicated to impact, invest in them, raise their visibility as impact companies. That's a fun and interesting thing when management of a company realizes, oh, we do impact, didn't know that. And so then they start to work in that direction and make sure they are what we think they are. And of course, that's part of the engagement. We were very engaged with companies to make sure their impact was important, what we'd like to see it be, and that their success is what we'd like it to be, because their success, if what they're doing is financial inclusion, just the fact of their financial expansion means they're likely to be having more impact as an impact company. So that's the theory of change. And the big thing that, I mean, the question is, do they know their impact company? Not necessarily, not until we get them into that mindset. But are they doing something that's highly impactful? Yes. And can we help them to be more impactful either by that visibility or by helping them out? If they're smaller companies, which ours were on the scale of public companies, we would introduce them to other people in their industry whom they didn't know, or to other people who could help them out. Or there's sometimes, I remember a great story with a company of good size in Europe doing battery materials. And their head of sustainability said, we're spending a lot of money having a top score in ESG. My board is asking me, what's it for? What do we get out of this? Can you help me with that? And so that was when we were at BlackRock, and I said, sure, we have a lot of people doing research on that kind of thing. Let me gather together research that would be relevant for you to be able to inform your board of why this has value to the company as well as to the world. But there's lots of ways you can engage, but you have to do it. A lot of funds that are in the public markets don't really do that homework. You can't really be a small firm or a small fund in public markets and do that the way I would like to do it.
So the devil's advocates on all this will say that you can't really get impact results on public companies because you're really just buying and selling shares on the secondary market. And I think I referred you to, and we talked some time ago about, my talk with Rokas Momarts of responsibility. He said, like, I don't, you really can't have impact. He doesn't really invest in public equities because he says you can't get that achieve impact. And you said you listen to that and you hear where he's coming from, but somehow you disagree. What do you answer to people who say that?
I think that you have to go into it with a high level of intentionality. If you are just owning them, then that's not good enough. If you're just owning them for a short time in particular, so our holding period has always been 5 years, and 5 years is enough to become a trusted partner with your managements. And furthermore, that part of why I say you have to do it in a big firm is if I walk in and I'm from Wellington or BlackRock, management's likely to give me the time of day, and they're likely to think about how our relationship matters for their relationship with other investors at the bigger institution. I mean, it's sort of an unfortunate fact of life for smaller investors, but that was important. And we could have those kind of conversations. And think about it. A company comes to me and says, we do this kind of financial inclusion, and we're in Europe, we want to be in the US too. And that implies certain kinds of regulatory actions. Well, guess what? If you're at Wellington or BlackRock, you have plenty of companies that are dealing with that moment of pivot to become international, and they can help the company that's smaller that is just at that moment. And we would put them together with our other portfolio companies or other portfolio companies in the firm that were at that moment and could answer their questions. And that was powerful for them. I would also say, so there was a Japanese pharmaceutical company, kind of small, become important and a lot bigger since then, where the CFO contacted me and he said, I just read that we're an impact company. I get this out of the blue LinkedIn message. And he wrote, that changes everything I think about my career and my firm. And I love that. And what I saw is, and we got to know each other quite well over the years, over those years, they started producing an impact report. They started understanding themselves as an agent of impact, and that the programs that they would do pro bono for the WHO with drugs that they developed were a part of that effort, not just the commercial side, but also in their corporate responsibility work. It changed them. It changed how the firm conceived of itself. And it was exciting to see that. So Rokas is right that just if you're just owning and buying and selling, if you don't have a long period, if you don't have a lot of engagement, that's true. You won't have real impact. If you can have more impact with a smaller company than with a larger company. And I would just say, if we're going to throw up our hands and say we're not going to have any impact with big companies, well, what does that mean? We're confining ourselves to niche? I don't want impact to be niche, but I want us to have engagement that makes a difference.
I guess it's a different level of engagement than when you're in the private markets and really got your fingers all the way into the management.
That's often true, but you've seen as well as I have, some private investors are not all that engaged. They're not necessarily pushing, they're making sure that they can tick the box on ESG criteria or that the company's in the industry it needs to be. But I've seen too many of those in public markets and in private markets. In public markets, it's existential. If you don't do that, you're not impact. And in private markets, you can kind of get away with it, and a lot of them do. I'll tell you a funny thing in the public markets. We worked with a researcher, also out of Harvard, but he was doing work on who's actually doing impact investing in public markets. And he had this data set of 650 ESG funds, out of which 150 were labeled themselves as impact funds. And he did a what's called a cluster analysis, a statistical analysis of their holdings, and concluded that out of the 150 that said they were impact funds, only 10 of them could really be called that. The other 140, his categorization was impact in name only. That's what I mean when I say it's existential. You have to be doing something different. And these funds were not different from funds that were just making sure that they were not doing harm, as opposed to companies that were doing good, that were active in solving social or environmental problems.
I remember when we first talked, and the thing that I think I liked about it is it's actually accessible to everybody because you're investing in publicly traded equities. And I think one thing, if I get constantly lots of people asking about, people want, non-professional investors want to, invest in all that. And most of the people on the show here, only running funds that are available to qualified investors, and most of this isn't accessible. I remember when we spoke, I remember, that's one thing I liked about what you're doing. It was accessible to everybody. I think even the title was something like
We used to say that.
democratizing impact, but that was just to get people to click. So on the same, another thing I liked, which I'm going to come back to right now, because remember that always is you had, right now ESG is out of fashion and impact is in on websites and marketing materials. And I also see the word sustainability being swapped out for ESG. But I remember when we spoke, you had a very clear definition about what is ESG versus what is impact. I would like you to go over that. My question is now with people kind of trying to get rid of erase ESG, is impact getting more confused in people's minds?
First of all, the very clear definition is that ESG speaks about how a company operates. You have a company making spirits, making liquor. Are they solving a great social problem? Some kinds of social problems, but they're probably causing more harm at the same time. But they can be run in a way where they're good to their employees and they're careful about what they do to the community and whether they pollute or not, and they could be really well governed. And in fact, there are companies that are very highly rated in terms of ESG. That's on the one side, but we've always thought about impact as being what they do. So the only areas that we were investing in would be the same. It's the same as what people are doing, a decade later. It's in access to education, access to health, financial inclusion, affordable housing, bridging the digital divide. And then on the environmental side, alternative energy or renewables, whatever you want to call it these days, access to water, resource efficiency, not wasting. Those are the areas that impact invests in. It's not that there's anything wrong with a company that makes high-end ice cream. I love a high-end ice cream. I'll eat that all day. But I would not consider that for inclusion in an impact portfolio. That's the real difference. And it's been conflated like crazy. And I suppose it's worth getting into what happened at BlackRock. The red states decided they didn't like woke capitalism.
Say what red states are versus
Oh,
blue, because
sorry.
outside of the US, even I can't hardly keep it straight.
You could call it MAGA. So the MAGA South, basically, 14 states, including Texas, led by Texas, decided that Larry Fink at BlackRock and BlackRock were too woke. And they were responding to Larry's calls for sustainable investing. They didn't want to invest with BlackRock. So they had to identify what was wrong with the investments. The returns were good. And so they identified, Texas specifically identified 6 funds at BlackRock that were so woke that they could not be accepted. You know, BlackRock had thousands of funds. Well, sadly, 3 of the 6 were my groups. So the writing was on the wall. And that was what they set out when they, Texas, blacklisted BlackRock. And then the other red states followed suit. I never thought what we did was ESG. What portfolio manager ever did not look at the governance of their portfolios, of their portfolio companies? What good investors did not look at whether there was going to be a gas leak by their invested in companies because that could affect valuation. What portfolio manager didn't before care about there was going to be labor strife that might affect the valuation of the company that they were invested in. So ES&G is an excuse. It's a title for something they didn't like. We didn't even do ESG more than anybody else. We had a typical approach, which is to ask and make sure that our companies didn't do bad things because that's a risk for any portfolio manager. But what we did that was completely different was investing in only those themes. So we were a thematic. We weren't ESG investors by any means. But I think BlackRock contributed to the conflation that it sold us under a larger umbrella of ESG or sustainability. We were a different animal from the beginning. It's hard to do impact except in public markets, except in a big asset manager. Fundraising's more straightforward. You can invest in your team. You can get access to managements. You can get visibility, but you could lose control of that message. So our message, at least at BlackRock, not at Wellington, but the message was this is ESG, which we weren't. And the message can be, as it was at BlackRock, we're changing our priorities. And with BlackRock, they need to protect their business because this external attack was foundational. So they changed their priorities. If you are invariably a small fish in a big pond, and any impact fund is going to be a small fish. So my lesson from that was for impact investors who don't want their message hijacked or to have the firm decide it has different priorities, a narrower focused firm is probably a safer bet.
For your theory of change for doing impact via public equities, you need to be impact investing from within a very large asset manager. And that wouldn't really work at a small asset manager.
It's harder to get that impact. Now, unless you have, as we do in the world, all of the large European asset managers who are through and through investing in sustainability. And the appeal to the team when we went from Wellington to BlackRock is we do only sustainability. Everything we invest in is screened for sustainability. And that was true until it wasn't. But it was very appealing when it was pitched to us, and that's where we moved.
The name of the fund that we spoke about, you mentioned 3 funds now, but this was Global Impact Fund that you and I spoke about on the show when I interviewed you. And again, that's episode 9. I encourage everyone to listen to that because it's really great and goes into a lot more detail. First, on your background, but how you were investing in that fund. And again, it was great also because that was public equities and accessible to everyone. It's still relevant today, even though the fund famously was completely shut down and capital was returned to investors, right?
Yes.
Yeah. You did talk about this backlash against ESG, but yeah, somehow you're blaming it all on Texas, but somehow there's a bigger picture here. What is that all about? And then I guess my follow-up question is, did impact investing somehow get tarnished with that as well? Because as you explained, ESG is quite different than impact. And from my perspective, it seems like it's ESG that kind of was front dead and center, and probably because it's not immediately understandable to people, whereas impact sounds like, yeah, who doesn't want to have impact,
I consider us to have been collateral damage to something that was a political issue unrelated. And that is what it is. I mean, Rokas also talked about conflation of ESG and impact. And I think there are promises people make. I agree with Rokas that there's no reason to think ESG gives you a better return. It probably gives you a better risk adjusted return. And I agree with that too. But I'm not particularly invested in ESG per se. I'm thinking about impact investing, and fine with me if people want to invest in ice cream or defense or whatever it may be. Those just are not impact companies in the definition that we conventionally use in impact investing. It has to be solving a social or environmental problem. Maybe defense does. It looks a little more like it in days of the Ukraine war, but it's not in the range that we usually talk about.
I think a little bit Larry Fink did this to himself as well, because I think he came out with some statements. Everyone has to adopt this basically to be banked by us. And I think Rokas said something like that. I hope I'm not putting words in his mouth. That it's kind of very American, where they just started. It started to seem like ESG was getting crammed down people's throats without actually anyone explaining the benefit of it. Isn't that what lit the fuse on this thing? Kind of this being top down, cram down type of thing. I always take the approach that, I'm just calling balls and strikes, right? And for me, it's like, if that is a better way of investing in the long term, consistently gets higher returns, you don't need to cram anything down. No one ever had to cram the idea of getting high returns down anyone's throat, right?
That's an important point. I think that things went too far. A lot of people say invest in ESG, you'll get a superior return. People sometimes said invest in impact, you get a superior term, you get a superior return. I never thought you needed that. I mean, if I lay out what we do clearly, we invest in these good things and those good things. And if you want to be invested in those good things, join us. But not because you'll get a superior return. We're professional investors. We're going to structure the portfolio. Our investment process will be such that you should be able to get a return that's comparable. And that is what we did. We gave investors good returns over a lot of years. The truth is, you have to invest for 10 or 20 years before you can really claim that what you're doing is producing sustainable alpha, sustainable outperformance, because some of it's just luck. So we had some good luck. Some years we had bad luck. But what I always felt was we were giving professional portfolio construction and research, and in ways that we were honest to people. But that was what our team was doing. I think beyond that, there was some overstatement, and it got a lot of pushback. I think that BlackRock did a lot of soul searching about whether it had overreached too.
And were impact investors partly to blame for any of this themselves?
The funny thing is, when you bring up Europe, is this never came up in Europe. Europe was very clear. These are things we want to invest in. We want to get the best investors in these themes and toward solving problems in the UN SDGs. and that's what they got. I'm not sure where it all came from because I wasn't in the politics of ESG, but I always wanted to be outside of it because we weren't doing ESG investing. We were just doing investing as impact investors.
So collateral damage. It's a drive-by shooting. So
Sometimes it happens.
you've described the benefits available from doing impact investing from within a large impact manager. Now you've significantly shifted your focus from public to private equity and focusing, I believe, on emerging market SMEs at a very different impact investor called SEAF. SEAF. Why don't you just give the headlines of SEAF, like what that's all about, but more importantly, how you got to this decision to go private after, really a long time in the public markets.
It was hard to leave bigger asset managers and public markets because it's what I've done. But I worked with a lot of the private strategies at BlackRock. So that also had its appeal, but SEAF is just the right intersection. So SEAF is a funny animal. It came out of CARE 36 years ago, which is the International Humanitarian Charity. And so it comes from a very deep emerging markets on the ground kind of operation. So intellectually, philosophically, and emotionally, they are aligned with what I used to do way back when in Rwanda or in the World Bank. And yet they're doing it with the market principles that I would want to see by investing in companies in the emerging world. And in fact, SEAF, it's small enterprise. So Thief only does funds that are for small enterprises. Interestingly, when I was looking at governments in Eastern Europe, and when Michelle was looking at company transformation in Eastern Europe that first time round, nobody was looking at SMEs. Nobody was looking at the small companies that are such can be such engines of growth and transformation. I mean, they have to get the banks to work, right? And we had to get the governments to work. But even 30 some years later, those SMEs are not really working. They're so far behind. And the fund that I'm going to launch is in ag and ag tech and food generally. All that is still quite outmoded and didn't have the chance to be modernized the way industry did. It's exciting to me to go to this area that was left behind.
How far behind has it been left?
The measured productivity in agriculture in emerging Europe, which is where my fund will be, is 40% of the productivity in Europe, in Western Europe. And by the way, we don't think of the productivity of Western European agriculture as being incredible either. So the use of land, the use of people, the amount of technology they deploy, it's all far behind. And in food processing, it's the same. And we're also going to be working on traditional retailers to make them more modern retail. There's investment across all of that that needs to be done that hasn't been done in large part, at least in the poorest countries of emerging Europe.
So you're seeing more opportunity for impact, but it will be on a smaller scale, or you think you're going to get somehow more result for the dollar invested or euro invested?
So SEAF's been doing this for a long time, and it's very hands-on and will be very hands-on. So company for company, it'll be more intensely impactful, I hope. And then doing this at a scale that's in the hundreds of millions of dollars instead of the billions of dollars, like what we did at Wellington and BlackRock, is to me, I wouldn't say disappointing. It's going to be less macro impactful and will get bigger the way some others have done, but we are walking before we run. And actually, this is stepping things up because what SEAF has done is small country or semi-regional funds that were subscale. They were $30 million, $50 million. We're going to start at $100 million scale and go on from there because you need a certain amount of scale to really offer the services that an impact investor needs to offer.
Is this going to be like blended finance, or is it going to be, market returns, or what?
The fund will be market returns, whether we need to blend in some blended finance for some kinds of investments, we don't know yet. But I think in these areas, it shouldn't be necessary. If you look at what emerging markets food industry returns have been, three of the top five sectors are in food and ag in everything that's been done in emerging markets. And one of the other ones is technology. It is such a fertile ground for returns as well as for impact that I don't see that this should be necessary. Remember, though, we're not doing hunger. This is for small enterprises that are trying to produce food or support food producers or doing food processing. So they're little companies. And the other area of hunger is an area for actually for the former parent of the organization I'm going to, a place like CARE, a humanitarian organization, or USAID that used to exist. That's where you can do that base of the pyramid kind of work. There's room for non-commercial rates for concessionary impact, but this is not that.
Once you get things rolling, we'll definitely revisit that and do a deep dive on it. Going to the overall impact market, the global impact investing market was valued at $102 billion in 2024 and is projected to reach nearly 300 billion by 2030, which is like a 19% compounded annual growth rate. And I think the Global Impact Investing Network, published a number of like $1.5 trillion in assets under management, with also like a 21% compounded annual growth rate. Not sure what the big difference is between those two numbers, but my question is impact investing mainstream now?
It's a good question. I would say it's hard with those numbers to figure it out. One thing that I would point out, I don't really buy the $1.5 trillion. I don't know what the right number is, but I think it falls short of that by some amount. I would also point out that the UN SDGs, which is only part of the goals of what people want. Those are the goals for emerging markets, not for the whole world. But UN SDGs are priced out to reach them at $5 to $7 trillion a year. So, and that's a flow. If the stock of impact investing is $1.5 trillion or something less, then we are nowhere near to financing what we need to. So we are a lot bigger. We're not mainstream. I told you, Scott, that when the show Billions started talking about impact investing, that was one indication that it was mainstream, even as silly as that was.
I'm still watching that thing. It takes me a while to plow through these things. I'm not a very avid watcher of series, but I'm still watching that darn thing.
Impact investing, at least people know what it means for the most part, or they think they do when it's mentioned. And there's a lot more money going there, and there are a lot more structures to to measure it and to parameterize what it is. And it keeps growing. And I'm enthusiastic, but I think that Ronnie Cohen's From Billions to Trillions is going to stay relevant for a long time.
Is that a new Netflix series?
Maybe that'll make it happen.
We just discussed, rather heady growth in the assets under management. My next question is, are the tools and the frameworks that exist to ensure and demonstrate impact, the risk is that they're not evolving at the same pace as these capital flows into impact? One question is about the metrics. Well, it's not only refining metrics, it's also about kind of safeguarding trust and ensuring that capital that's allocated genuinely contributes to positive real world outcomes and just aligning with broadly defined, feel good themes. It seems like we're at a critical juncture. Are the tools developing fast enough? How big of a risk is this?
I think I have a different view from most people in this industry. I think the tools are evolving and mostly in good ways, but that they should be evolving a lot faster in terms of simplification. Hedrick Kuiper from Triodos Bank said that we have to worry about whether these mechanisms for measuring impact are so burdensome on companies and investors that it gets in the way of things. And I've always thought that is a risk and a problem. I mean, especially for venture companies, if the things that we ask of them, I say we generally in the industry, the things that are asked of them to report are too much, are too complicated. And I thought that in public markets, that they became a barrier to entry for smaller fund managers for public markets investment. I think the simplification to the essence is what is needed. And in any case, no matter how good impact management is, if someone wants to game the system, if someone's selling something as impact, but it's what the researcher called impact in name only, you're not going to be able to tell from the system that is in place for measuring it. Asset owners have to be sure that they can trust the person who's doing the investing. I said it's always a matter of looking under the hood, not just taking the glossy presentation and believing that. And so I think one, it's incumbent upon the asset owners to figure out what questions to ask to judge whether the people they're dealing with, here's a term I hate, to repurpose a fund. I wasn't involved in that, but there were often funds that were repurposed to be EU SFDR 9
Yeah.
funds or
Yeah.
repurposed to be sustainable funds. If it wasn't to begin with, what are you doing to repurpose it? I find that's usually dubious. And so you need to know whether the person that's in front of you presenting a strategy to invest in is yesterday was a rapacious investor, and today he or she is telling you all they care about is impact. Because that's a reality of the industry, and regardless of the measurement. And so then measurement, the basic bones of it are good, but it's been overdone, overcomplicated. So I think that's where it needs to evolve.
Accounting industry really hasn't shown up in impact yet. I mean, there is no census on how to measure this. It's really all being done by each individual company, which, as I say that to you, it's kind of funny. And it seems like the accountants are the first ones, where they can increase billings. What do you think? I had Sir Ronald Cohen on a couple months ago talking about IFVI, which is the International Help Me Foundation of Valuation of Impact or something like that. Sorry.
Yes. Yes. That's his pioneering effort. He points out that it took decades for gap measurement to be generally accepted. And he's trying to rush this along and he's making progress. But still, it's not generally accepted and it's not available for every company and every kind of company. But it's an important, not even a first step, it's an important next step. And TPG Rise has their own methodology that they put out, which is another important step. I don't subscribe to either of those particularly, but they're very interesting and they come from a place of experimentation and authenticity, and it will take time. The industry is new, and it'll take time for there to be one generally accepted or a couple of generally accepted approaches. But these are good contributions to the corpus of that effort. The impact management project, IMP, is maybe the bigger one in my mind that moved us forward and asked some of the right questions. I don't know if you ever had anybody from IMP on your podcast, but that was the big leap forward 5 years ago, 6 years ago.
I don't think I've had a single episode where impact washing or greenwashing doesn't come up. So as this market expands, like we've discussed, where are we with this problem?
I think it's less of a problem than it used to be. I think people now have a sense of what is an impact investment. There's room for differences of view. I mean, if you're investing in small nuclear reactors, most people in Europe have started to think that might be an impactful investment. And it wasn't before. If someone had said that to me 10 years ago, I would say, you're kidding. That's total impact washing. But I think the world's changed. I think there are ways we will continue to think about things differently. But to some extent, you can know impact when you see it. If you see a fund that's invested in Visa, perfectly good credit card company, but are they solving the world's problems? Are they innovative at the level of inclusion at the base of the pyramid? Are they giving us products that create transformation for societies? I don't think so. I mean, I'm a client, but I don't think they're an impact company. I don't like seeing them in an impact portfolio. And there are a lot of companies like that where you have to ask yourself, is that really credible? Do we not have enough themes for people to invest in that across all of social and environmental themes? I think we do. There's some tricky ones. I mean, the nuclear example is one, but mining, is it environmentally a problem? It can be. Are we mining for materials that go into renewables and batteries? Well, then maybe it's impactful. So you want your investment team to be thoughtful about how they came to a conclusion.
Where you just joined at SEAF, the UN SDGs are central, as far as I understand, to their strategy. But I think most people would say that there's been mixed progress on advancing the SDGs. In fact, I think the 2024 report from the UN, I got it somewhere, says the 17% of targets are on track, with progress on over a third having stalled or regressed. Is there something wrong with the framework, or how can impact investors use this framework more effectively?
Like most things, there's a complicated answer. When the UN SDGs came out in 2015, I thought, great initiative. It will never be reached. Like so many things like that, it's aspirational and let's try to be a part of the solution instead of the problem. Great. But it was never going to be reached. It was never going to be reached by the 2030 timeline that they had. And I'm surprised any are on track. But the fact that some have stalled or regressed is quite disappointing. And I'd like to know what they are. I haven't looked at that report. And so maybe that's one answer, that we have to focus on what's not getting investment dollars or what's being thought about incorrectly. The World Bank, over its 80 years, has rethought its mission and rethought how it goes about its mission many times. It's reinvented parts of itself when it learned new facts from the old days when it was trying to make Western Europe modern. That worked really fast and well, but other places haven't, and they had to relearn things. And in the same way, the UN and impacted investors will have to approach things in different ways. We should remember that the UN SDGs were not a call to action for impact investing. They're mostly, and when you look at the UN Sustainable Development Targets underlying those goals, most of them are in language that corresponds to actions that governments will take. And so it's not a one for one match to impact investing. And for impact investing, think about where we were in digital inclusion 10, 15, 20 years ago. Think about where we were in terms of renewables and alternative ways to approach energy. And think about what's happened with hunger and with everything in the social areas. I mean, there's been improvement across the board, but impact investing doesn't do everything, and impact investing isn't succeeding in everything. So I think it's good to have that framework out there. We launched before there were UN SDGs, but it made it possible for everybody to speak a certain language together, and that's what we have. It's really mostly a language, and it's a way of fact checking ourselves.
What about the Jin's report, Seven Things to Watch in Impact Investing in 2025? Any comments about that?
So it's good. And when you look at the list, I don't think we want to go through the list right now, but it looks about right. There's a lot going on. Markets in EM and Asia are becoming more important. One thing that I would say that I was troubled by, or troubled by the facts, not by what they said, was they said EM investing, emerging market investing, will be getting more global attention. Well, yes, it's getting more global attention from impact investors as ODA, official development assistance, is in steep decline. So it's making up for the retrenchment that's happening officially. The second thing is continued interest in blended finance. Well, it's just not true. Blended finance has been in backward motion for the last 2 years. I would phrase it as there's continued need or demand for, because it's super important. But one, the provision of blended finance is not coming right now. And two, the definition or mechanisms for it are still very incipient. And so blended finance is not where it should be. Maybe if I had written that, I would have said blended finance has so much promise and it's not where it should be.
What about the PRI, the Principles of Responsible Investment 2024, reporting data on 2025 trends? Any observations or comments on that?
Michelle Giddens talks about the spectrum of impact from responsible investing to ESG to impact investing and so on is so broad. I mean, what they're talking about is everything all the way to do no harm. So what they're focused on is something completely different from what I think the audience of this podcast is focused on. They are responsible to and nudging along every company in the world. That's their remit. And it's great for what it is, but it's beyond what we're all doing.
Before we wrap up here, we've got over 85 episodes now of the podcast published. Just wanted to check in with you for a few minutes, to for you to comment if you had any reactions to any of the recent impact investing episodes, anything that surprised you or you wanted to comment on.
Just a happy thought is when I hear all these pioneers of impact investing in your recordings, we've moved from father of this or mother of that to grandparents. I mean, in some areas, this has been going on for now a couple decades. And it's really very encouraging to see how multifaceted this all is, how many different approaches, what we now take for granted that we wouldn't have before. And it's clear how much potential there is. When those of us who were investing in early parts of our areas of impact investing, the question was, is this charity? Is this concessional? Can you do this? No one has to ask that anymore. It's been established. A good investor can make a good investment in impact investing like anything else. And this question of do you have to give up return for impact? Well, everybody can see now that you don't have to. You just need to find a good manager because that's what matters. Or you need to have a well structured fund. And it's good not to be back at the very first principles every day, that we're building on something and building on the shoulders of those originators from the earliest days.
Yeah, some of the episodes we've mentioned in here, I think, are some of the more recent impact ones. Hadwick Kuiper of Triodos Investment Management. That was episode 83. And we mentioned my interview with Sir Ronald Cohen, episode 73. That was really very interesting. If nothing else, listen to his story, escaping Egypt. And then episode 58, Rokas Momarts from Responsibility. Actually, there's two episodes. It's episode 57 and 58. I split it up because he was absolutely a gold mine on the beginning of all this stuff. I don't know if you listened to the first one, but he was there at like when this wasn't called anything. It was called like governments handing out money, and then he had to do this report on the benefit, and the report never got published because there was no benefit. And it was great. And that's kind of what responsibility came out of. A couple Swiss guys wanted to form the company, and he was working with them, but then asked to join it. Now he's been the CEO. Just from the history aspect, it's amazing. And then you mentioned Michelle Giddens. All very interesting to hear how this all came about.
And different in Europe than in the US, because in Europe there were institutions that were interested in it. The US, it was just very grassroots.
And Rokas started out like in Latin America, being sent to run around there. German speaking guy down there didn't speak Spanish. Yeah, it was amazing. All of these stories are really good. Michelle Giddens is a very interesting story about sitting across the table from Sir Ronald Cohen with a blank sheet of paper, as you described. All right. Well, Eric, thanks for showing up today. It was great. Really good to see you again. And thanks for going through all this. Definitely get you back on, find out more about SEAF once you find out, as I said, where the coffee machine is.
I'll be excited to come back. Hopefully we can make a difference.
Well, thanks a lot, Eric.
Thanks for having me, Scott.
Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.